All right, welcome here to we are in week 13 and doing chapter 12. I'm going to pull up my screenshot for Blackboard. So as you can see here, we're at session 13. Just to give you a little bit of overview of where we're heading for the rest of the semester. Definitely this week is the last tough week, in my opinion. This is another tough week, like Chapter 7 was pretty tough. Chapter 12 is dealing with like-kind exchanges for the most part, and that's kind of a new area, so therefore it's kind of tough. I believe rental properties is quite a bit easier, as you'll see when we talk about what is called Schedule E, dealing with vacation homes. Those are I think you'll find that easy. I also have a nice extra credit opportunity inside, doing a couple extra tax returns if you want that as well. And then the last 2 weeks are simply review and taking the VITA Advanced exam as well as my regular final exam. The final exam will not be cumulative. It'll simply be the last 8 weeks of the course. So knowing everything from Schedule C with having your own business, and then with IRAs, we had a week on IRAs, capital gains that we just did on Chapter 7, and this week, and with rental properties. We'll talk more about the final. You should already have the proctor form at your proctor center. I sent that with the midterm. They got there at the same time. So if you need to make an appointment, you should be able to go ahead and do that. As we go in here to session 13, I'm going to follow along with my notes in the learning activities. In the assignments, there's just 2 things this week: the regular homework and the Chapter 12 tax return. We're just doing the 1 chapter this time. We had quite a few tax returns this last week with Chapters 6 and 7. We'll just do Chapter 12 by itself. All right, we're going to now pull up my Word notes. All right, so let's go through the good and the hard stuff here for Chapter 12 and hopefully less, right at an hour or so, maybe quite a little bit less. The first part, this is just copy and pasted from last week's discussion. It's that important, I believe, knowing the difference between what's considered a realized gain or loss and recognized gain or loss. Realized basically is what normally is going to happen when you have a purchase price minus your basis. What's the normal gain or loss? When recognized means if there's any special tax rules, what are you actually recording? And then I give you some hints here about recognized gains. They'll never be more than your realized gains, but they definitely could be less. For example, one that we talked about, I think it was last week, when we sell a home, you could have a realized gain of $100,000, but be recognized as 0, because if you remember, you can offset $250,000 of realized gains and not even count them at all. So you can definitely have less realized gains. And just in that example, it was less, and it was also 0. Your realized gain was 0. Your recognized gain was 0. Even though your realized gain was $100,000. However, it will never be flipped. You can't have a realized gain but a recognized loss. That just doesn't make any sense. So this week, we're going to talk about, well, what happens if in one of 2 scenarios. What if you make a trade with some other partner of yours, and you trade 2 similar things, like 2 pieces of land? One company swaps land with another company because it's in a different position. It's better for their business for whatever reason. How are tax items like that treated? And the other aspect of this is, like-kind exchange would be, what if something happens to your item that you had and it gets in a fire and it's destroyed or it's theft, and then you're reimbursed for it by insurance, but then you go and buy the exact same asset to replace it. Should you have a gain or loss in that situation, and how is it recorded? So those are the two big items that we're going to look at. We'll have a couple others here and there. For the most part, that's what Chapter 12 is going to talk about. Okay, so with changing two things that are very similar, it's called a like-kind exchange. Section 1031, remember last week we talked about Section 1231 assets, and those were business assets that you've had for more than a year, and then you get to take the gain treatment, special capital gain treatment, where you're taxed at a lower rate. And also, if you have a loss on it and it's a Section 1231, you can use all of the loss instead of just $3,000. If it was just a personal use asset, remember you can only take, or excuse me, a investment type asset, you can only take $3,000. With personal use, you can't take any. Remember the example I used was, you have your own personal car, and you bought it for $15,000 and you sold it for $3,000 10 years later. You are not allowed to put on your tax return that $12,000 loss. That's just not allowed. So we're looking at primarily business stuff here, Section 1031, where it's we talked about like-kind. So notice here, to be like-kind, they need to be a similar item, not necessarily in value. So you could exchange two cars, and even though one's a junker and one's a brand new car, as long as they're similar, then that's okay. They don't have to be similar in price. And then land as well. Even though land could be a totally different type, parking lot versus a beach property, still land. I think parking lot or a city lot is what I meant. City lot. Parking lot would be a land improvement. Personal property, it's got to be land. Again, that can be land is land, but personal property, it can't be just 7-year assets. It's got to be the exact type of 7-year assets, so they're very similar type of equipment. Tax law even breaks it down further that a truck is not the same as a car. A car is more used for personal people transportation. A truck is more used for to haul things, so they do not consider those the same. So it got to be used in a business, and you could even claim investment, but typically most investments are in stocks, and there's a specific rule in this like-kind exchange that stocks, you do not get this treatment with stocks. So just because you sell a stock and then you buy another stock, you still would have to record a gain if you had it. All right, so let's look at a couple of examples and then what I'm asking here for. So we had a car in our business, and we had already depreciated it completely, so its basis is 0. However, it still has a little bit of value to it, $3,000. And then we trade in for a slightly newer car, happens to have the same fair market value, so it's an even swap. Didn't have to exchange any other cash or anything else. What is the realized gain, recognized gain, and the new basis? Okay. So realized gain is simply what did the questions that you ask yourself. What did you get? You got something worth $3,000. Less, what did you give up? You gave up something worth 0 on your books. That's what I mean by what did you give up. Not its fair market value, but what it's worth on your books. So we actually had a realized gain in this situation of $3,000, and there's no special tax treatment in this type of situation. Well, actually, yeah, there is, because we traded 2 cars together. So we had a realized gain of $3,000. However, recognized would be nothing, because it would be a like-kind exchange, a car for a car. And then I said, when I asked the last question here, what's the gain or loss? What's the new basis? And with basis, what we're going to look at in a little more detail later on is you start with the basis of what you gave up. That's always your starting point. What did you give up on your books? And then you'll see in a little bit we have to add in if we received cash, or subtract out if we paid cash. Add in if we recorded a loss, subtract out if we recorded a gain. We didn't have any of those situations. No cash, no recognized gain or loss. So our basis stays the same, and it's still 0. So the car on our books, we can't depreciate that newer car because it's really a like-kind exchange, like we had the same thing for tax purposes. The second example here, we've started to depreciate our furniture, $500. It's still valued at on our books. However, it's worth about $1,000. We trade that in for a computer with a fair market value of $1,000 as well, so it's an even swap. However, furniture and computer are not exactly the same thing, of course. So this would not be a like-kind exchange. Therefore, any realized gain or loss will also be our recognized gain or loss, depending on if there's any other situations, as long as there's a couple things here I don't mention. Is it a Section 1231 asset, meaning is it, have we had it for more than a year? We don't really necessarily know that, but we'll assume we have. So realized gain, again, what did you get? You got something worth $1,000 minus what did you give up? Worth $500. So you have a $500 realized gain. No special rules in this one, so it is also the recognized gain. And then, as you'll see in a little bit again, to get our basis, we take always start with our old basis, add in or subtract out any cash that we received or was given. That didn't happen. However, there was a recognized gain, and if there's a gain, we can add that to our existing basis. So in this case, our new basis would be 500 plus the 500 gain that we recorded. So our basis has now jumped back up to $1,000. Note here now, if there's related parties involved with a like-kind exchange, most of the time it's the same rules, except if either party within 2 years gets rid of the asset that they exchanged. If they got rid of the asset, then the other party as well must record any deferred gains. So in this case, back up here where we had a deferred, we didn't have any gain, we had a recognized gain of 0. Deferred though was 3,000, because if there was no special treatment, back up here in example 1, if it wasn't like kind, we would have had to record a $3,000 gain. But since it was like kind, we get to defer that 3,000 till later when we sell the car for something else, cash generally. So we defer that 3,000. If this would have been a related party sale and the other party would have sold my car that I gave them within 2 years, then that 3,000 realized gain would have all of a sudden become recognized at the moment that the related party sold the vehicle I traded with them. So basically it's there, so there's no weird tax aversion going on, avoidance. So I give an example, and I set up this little chart to help us to visualize, how to maybe see this a little differently than just numbers written across here horizontally. Try to put it into some of a chart. I think it helps. If at the beginning of 2014, there's a mom and son who do an exchange. The mom has an apartment building and the son has a warehouse. Well, remember back up here with real property, basically any type of property is considered like kind, even if it's not exactly the same. So that's a big difference between real property and personal property. Personal property, they got to be identical. Real property, not so much. So apartment building, son's warehouse, they exchange it. And they give us the background here. Mom, it's worth $150,000. Son, $125,000. So basically the mom is saying, I'll give it to you plus a free $25,000 because mine's worth more, but I'll take yours even though it's worth a little bit less, kind of gifting her son $25,000. Son sells the apartment building in 2015, so just a year later. Has not hit the 2-year rule. So we're going to look at what's the realized gain or loss and recognized gain or loss for in 2014 when the swap happens, and then what happens in 2015 when the son does sell, therefore creating a bad opportunity for the mom because now she has to record all of her gain that she previously didn't. Okay, so we're looking at, go to my answers. Go for the first one here, mom's realized gain. What did she get? She got something worth $125,000. She gave up something worth $100,000. So right in here, I would show that mom had a realized gain of $25,000. However, since it's like kind, 0, and since no gain or loss was handled or there was no cash exchanged or anything similar to cash, any other item, then her basis remains the same as it was. Her basis was $100,000, so that's still her basis. The son has a realized gain. What did he get? He got something worth $150,000. He gave up something worth $75,000. So he has a $75,000 realized gain. Again, it's like kind, so 0 of it's recognized. There were no gain or loss recognized, no cash given or received. So the basis is the same as it previously was for the son, $75,000. Now, in 2015, the son turns around and sells his item, and he sells it for $160,000. So the son, what's he get? He gets money, $160,000, less the basis, his new basis, which is the same as his old, less the $75,000. So he has a realized gain of $85,000. Let's go back up here. Here's the son. Realized gain of $85,000, taking what he got minus what he gave up. It's realized and it's also recognized because there's no special tax treatment in this case. And there's no basis either because he got cash. He didn't get another asset. So new basis is not even applicable. Now we go back up to the mom. At the moment that the son sells it in that year, she now has to turn that $25,000 realized gain into recognized gain, pretending like it was not a like-kind exchange. So that's bad for her in this point here in that she has to record $25,000 in gain even though she doesn't have the cash to potentially pay it because all she did was an even swap. And now she's having to pay a taxable gain without possibly money to do that. She will have an updated basis on her asset because she did have a gain. So the rule is whenever you have a gain, you can include that. Whenever you have a recognized gain. So her new basis is now instead of $100,000, $125,000 if she would ever sell the item that she has. However, now we get into this boot. Most of the time, items don't have the exact same value, and you can't do just an even swap. I'll be right back. Okay, so again, the exchanges usually aren't exactly equal, so some other form has to be treated in addition, some non-like-kind item. A lot of times that's cash. It could be another item that's different. It could trade a computer and a printer or something, I don't know, something, and then exchange it for the furniture equipment, the furniture set. You might have to exchange 2 items instead of just the one. And that second item would be considered boot. But again, it's usually going to be cash. That's the boot. And that's what the term in tax is called, when something other than the 2 like-kind items is involved. Again, most of the time it's cash. So you give up 2 items and they're not quite identical. And it tells here that relief from a liability, like giving somebody your mortgage, now it's all of a sudden in their name. For tax reasons, that's just the same as receiving cash. So if you have a $25,000 mortgage on your house and you exchange it for somebody else's house and they take your mortgage, that's like you getting cash for tax purposes. Therefore, it would be taxable, even though the 2 house parts would not be. So when we have a like-kind exchange with boot, it's okay in that we can still do the like-kind exchange. It's just the boot portion is going to be treated taxable for the person receiving the boot, receiving the cash. So if you give up a mortgage, it's like receiving cash. Somebody paid you cash to pay off your mortgage in a sense. Receipt of boot is a trigger of gain, of course, if there is a gain. And we did something like this in Chapter 7, and the amount of gain is the lesser of the boot received. We did the depreciation recapture was, I believe, in Chapter 7. We did like the lesser of the gain or depreciation taken. So this time the recognized gain is the lesser of the boot received, like cash, or the realized gain. Giving boot, so you're the one paying money, does not have any tax consequences except for the adjustment of your basis in the new property. But you won't record anything right away on your tax return as having a loss or something like that. So here's something you'll definitely want to have in your notes for the test, at least I think, unless you memorize it. What to do when cash is involved, boot, with a like-kind exchange, what to do if there's gain or loss recognized, and how boot's affected. So I have an example here. Tom is giving up an asset on his books that's worth $500, and it's worth on the fair market $3,000. We assume in this case it's a like-kind asset, since that's what we're talking about. I didn't put that in here. We assume that. Tom, he's giving up a $3,000 asset in exchange for a $1,000 asset, so therefore DISA is going to have to make that up. And so Tom, when the trade happens, will be receiving cash or boot, and DISA is paying the cash or boot. DISA is giving up an item on her books that's valued at $500 on her books. It's worth $1,000, again, compared to the $3,000 that Tom's giving up, and she's paying money. So what is the realized and recognized gain for both parties and the basis? Tom. 2 questions. What did Tom get? Tom is getting something worth $1,000 plus $2,000 in boot. So he's getting something worth $3,000, and he's giving up something worth $500. So 3,000 minus 500, a realized gain of $2,500. Recognized, well, it's a like kind. However, there was boot involved. So we go back up here. Recognized gain is the lesser of boot received. Boot received was 2,000. Realized gain was 2,500. So our answer there is obviously the lesser of the boot received. So we had a realized gain of 2,500, a recognized gain of 2,000. So here's my realized gain. What did you get minus what you gave up on your books? Recognized gain, the lesser of the realized gain or the cash. And then our basis. Remember, go back up to our formula. Old basis 500. We did receive some boot, minus 2,000, but we did record a gain of 2,000. So those two kind of wipe each other out, and we're simply left with our old basis is all that's left. So a $500 basis. Okay, Disa. Always start with the same questions. What did she get? Disa got 3,000. She didn't get anything else cash-wise. That's something that she gave up. So she got 3,000 minus what did she give up? She gave up $500 of an asset, and she gave up cash. So she gave up $2,500 worth and only got $3,000 worth. So she had a gain of 500 realized. Since she did not get boot, all of this is a like-kind exchange then. Therefore, none of the 500 is recognized. When you pay boot, that doesn't trigger any gain or loss. It's only when you receive it. Her basis, we go back to the formula, there was no gain or loss, but there was boot paid. So the basis jumps up to $2,500 up on her asset. Okay, do a similar one, except this time we're dealing with, instead of cash being received, it's a mortgage. Somebody's trading off a mortgage. So it's kind of like cash. So Michael has an asset, probably a building, since we're dealing with a mortgage, as a building on his books worth $300,000. He's getting $470,000 building, fair market value. And that's the main reasons between any of these adjusted basis and fair market. It's not that the item went up in value. Same here, not that the item went up in value. They just have started taking depreciation. So the difference, what did we get minus what did we give up? Let's start with Michael. Michael got $470,000. Actually, I'm sorry, this is a fair market before trade. Michael got $350,000. So that's what his asset was worth. Let's go back here. He had this on his books right before the trade. This is what he's getting from Rebecca. He's only getting something worth $350,000. But the upnote is he's giving up his mortgage. So it's like he's getting cash. So he's getting $350,000 of new stuff plus getting rid of his mortgage. So it's like Rebecca's paying him $120,000 to pay off his mortgage because he no longer has the mortgage. So really, it's like he got $470,000 of stuff minus what he gave up, $300. So he has a realized gain 470 minus the 300, 170,000. Since he did receive boot, in this case it was getting money to pay off a mortgage or simply trade the mortgage, we take the lesser of the boot received or the gain realized, and it's the boot received. So of the 170, he's going to have boot received of 120. Therefore, that's his recognized gain. And now we can also do the basis. Just like before, the cash received or boot, in this case because it's a mortgage, plus the gain recognized, they wipe each other out when going back to the formula. And all that's left is the old basis of 300,000. Now with Rebecca is getting this $470,000 asset. She's not getting anything else. She's actually paying money, paying like getting a mortgage. So that's something she's giving up. So she got 470 minus the 250 that she gave up, minus the 120 that she gave up to acquire the mortgage. So she gave up 370,000 of stuff and got 470. So she has a $100,000 realized gain. Since there was no recognition of boot, this would be a like-kind exchange, thus nothing is recognized. Her basis, though, will go up because she paid money or paid boot. So her basis will go from 250 plus the 120 that she paid in boot. So she'll have a $370,000 basis if she wants to start depreciating that, or when she sells it. If not, she'll use 370 as her basis to determine any new gain or loss. The second part, so we talked about the first part, having two parties exchange. The second idea is, well, what happens if your item gets taken away from you by some means that you weren't ready for, like a fire or a hurricane or whatever it may be, and then you rebuild again? And if you got insurance money to cover that or whatever it was, should you count that as gain? So if you had a $100,000 building and it was completely destroyed, it has a basis now of only, say, $40,000 because you depreciated it for many years. However, it's worth $100,000, and the insurance company pays you $100,000. Technically, you would have a $60,000 gain. What you got was $100,000. What you gave up was something worth $40,000 on your books. So you'd have a realized gain of $60,000. But the tax law has a special area here called Section 1033 that says, well, if you reinvest in a very similar type property than the one you lost, you don't have to record that gain if you invest all of the money. So that's what we're going to do here. So by default, if you just receive the money on the insurance and you don't do anything with it, you have to record a gain. But you can postpone that gain or defer it if you reinvest within 2 years of the end of the year of whatever it happened. So if it happened in July of 14, you have until December of 2016, 2 years of the end of the year, to replace the property. You can even have 3 years if it's considered real property. You lost a building. And then the other situation is, well, what if you didn't use all the proceeds? So if you got $100,000, but it only cost you $90 to rebuild, then that extra bit that's left over, that is considered a recognized gain that you got and then you didn't use. And we'll look at this basis here in a minute. The basis is very similar to the equation that we had above. Always start with your old basis. It's always something you want to keep in mind. And then if you add any, you can add on. If you go back to my $100,000 house building, instead of it costing you $90,000, it cost you $120,000 to rebuild. So you had to throw in an extra $20,000. Your new building would, on your books, would be old basis is $40,000 plus an extra $20,000 that you had to throw in of your own money. You don't count the insurance money. So we would have a property valued at $60,000 with nothing recognized. The only time, again, you can use this type of, when you have a casualty, like what we talked about last week in Chapter 7, personal use assets, the only time that comes into play is if you itemize and have decimal casualty losses, which you don't get to use very often because of the high limits. Okay, so in this example, office building basis of $120,000. Insurance says it was worth $150,000, so they give you $150,000. It costs you $140,000 to rebuild something similar. What's the gain or loss in this property? So what did we get? We got $150,000. What did we give up? Something worth $120,000. So we have a realized gain of $30,000. We can defer most of it, except we cannot defer the $10,000 that we didn't use on the property. So it's a recognized gain. So our new basis of our property would be old basis, $120,000, plus the gain that we recorded. So we have a basis here of $130,000 of our new building. Okay. Next example, everything's the same except instead of costing $140,000 to rebuild, it costs $190,000. Therefore, in this case, we didn't keep any of the money, so we have no recognized gain. The realized is still the $30,000. None of it is recognized. And we would up our basis by the extra $40,000 that we put in. So again, it'd be $30,000 realized, $0 recognized, and then take old basis plus how much of our own money did we put in, and that would be $40,000. So $120,000 plus $40,000. And in the case for number 7, we took all of the money and kept it. So our realized gain is our recognized gain. And we wouldn't have a basis if we don't have an asset anymore. We just have our cash. Installment sales. This is, like how I have it here, it's like selling a home on a contract, in that if you sell a home for, say, $60,000 and you had a basis in it of $20,000, so you sold it for $60,000, but on contract and it was worth to you $20,000, you'd have a $40,000 gain. If there wasn't any special tax rules, you would have to pay a gain on $40,000, even though you're not going to get a lot of the money until sometime later on, because you're not receiving the full payment of $60,000 right now. So should you be expected to pay the full tax? And the answer is no. So it's what's called an installment sale. So as I say, you usually receive some kind of a down payment and then monthly payments after that. Some of those monthly payments go to interest, and some go to the reduction of the loan. It's kind of like the the individual who owns the home is acting as a bank as well. They're being the bank for you, whoever's buying. So when the person pays, some of the gain will go towards, or some of the items will go towards interest. Some of the money that's going towards a note, some of it goes to the gain, and some of it goes to the basis. We're gonna look at that. So for this example here, if I had a $60,000 home that I was saying I sold it for 60 and it's worth, to me, it was on my books for 20, I'd have a $40,000 gain. Well, then if somebody pays me, say, $400 a month, so of that 400, a piece of it, maybe 10%, goes to interest, so 40 bucks. And then of the 360, how much of that 360 do I have to count as a gain, and how much do I count as a return on my investment to cover the $20,000 initial price? And that's what we're going to be doing here. Because I don't want to have all 360 be counted as a gain. I want it partially to go to the gain and partial to the reduction of return on my basis. Again, there's going to be some depreciation recapture. So when we sold it for, depending on what we bought it for, say we bought the house for 50 and it's now worth 20 on our books, so that means I had a $30,000 depreciation. The gain must be first attributed to the depreciation recapture, and I don't get the special gain treatment. The remainder, once I've done the depreciation recapture, the rest of it would be capital gain. So here's my example to help all of this make sense. So in this example here, we sold something for $45,000. It was worth my books $30,000, and I had taken $7,000 depreciation. So therefore, the original purchase price was $37,000. Sell expenses, which included, say, the real estate broker, they charged me $2,000 to sell the home. All right, so at first glance, I have, what did I get? $45,000. And then it depends on how you do it. It comes out the same. What did I get? 45, well, less the 2,000 in expenses. So I really got 43,000 minus the basis of 30. So I had a $13,000 gain. 7 of that would be depreciation recapture. The other 6,000 would be capital gain, section 1231, where I get to use the lower basis, or the lower taxable. However, I don't want to record all of that $13,000 gain in the first year if I don't have to. Because I'm only receiving, out of the $13,000 gain, I'm only receiving $5,000 in year 1. So I would hate to have to pay tax on a $13,000 gain when I'm only paying $5,000, when I'm only receiving $5,000 of the $45,000. So of the $5,000, we're going to assume 10% is interest. So then we tax the interest separately. So what we need to do is determine how much of the gain should I be taxed. I got to get a percentage. And so here's the formula that's laid out. What you need to do is take your sale price, what you're receiving, plus any debt that you may have given up, which I don't know how often that happens, but so in this case it was just $45,000 the sale price, and then less the $30,000. That was our basis. And they're saying go ahead and take out the selling expenses because you didn't really get that. And they want you to go ahead and take out the depreciation recapture right now because you're going to add that back right away anyway. Depreciation recapture, you don't get a benefit on that. So of the, what's left here is we got $6,000 that's going to go towards capital gains. And that's what I had said back up here originally. $7,000 was going to go to depreciation. The remainder 6 of the 13 is going to go towards the capital gains. And this is the piece that we're going to spread out. Right, so now let's see how we're going to spread out the 6,000. Gross profit, 6,000 divided by the contract price. Contract price for this one was 45,000. So of the payments received, it's not interest, unless 13.33% goes towards gain. So this is what we're going to do on our tax return for this first year. Out of everything that was involved in the 5,000 that I actually got, the first thing, anything that was a recapture, you have to count that in the year. You don't get to do an installment sale item, on that particular piece. So the 7,000, we've got to put that in as a year one right now, all of it, and be taxed on it. We don't get to do special 13.33% on that amount, unfortunately. We only get to spread it out over what's left, the $6,000. 500, the interest, goes directly to Schedule B. Interest received, interest earned. And then we're left with $4,500. 13.3% of that would go as capital gains and be taxed differently. The remainder is simply return on my investment, and you're not taxed on it. You can look through then example 8 on your own using my notes to see how you do. The last item that we're going to talk about in this chapter is related parties. We've already talked about related parties with like-kind. Now we're going to look at related parties that have non-like-kind exchanges and what happens. This is very similar to when you had gifts in Chapter 7, when there was gifts involved, where the donor doesn't get to take a loss, but the person receiving it, their basis will kind of depend on what they ended up selling it for. So no loss allowed on sales to related parties. So if you have a loss, you're not going to get to take it, just like with gifts. You still would report a gain. So if you had a gain, it's just maybe not as big as it would have been if you sold it to an unrelated party. You still record the gain. And then it gives you a couple of items like who's a related party. And they're saying anybody that's ahead of you in your birth, meaning like your parents, your grandparents, anybody on up that way, descendants, your kids or their kids or anybody down that way, siblings and spouses would all be related. Any corporations you own more than 50%. Basis. If there's no loss involved, meaning that the other party that gave it to you gave it to you at a fair price, or they didn't have a loss, then your basis happens to be the price paid. Pretty simple. But if your person that gave you the item did have a loss, so they had something worth, it was worth 10, but they only sold it to you for 6, there was a $4,000 loss there. The giver can't take the loss, but you might be able to offset any gains later on, just as we did with the gifts. So let's look at this example to help explain it. Dad sells the stock to his son he sold it for $100. The dad has a basis of $150. It's worth $200 right now, the same stock. So Dad, in a sense, what he's getting $100. He's giving up something worth $150. So the dad has a realized loss of $50. However, the giver cannot have a loss. So therefore, the dad doesn't have anything. Now the son. It says the son turns around and sells it for $250. Well, the son bought it for $100. So if there was no special treatment, the son would have, what did he get? $250 minus what he paid for it, what he gave up. He gave up $100. So he would have a $150 gain. However, he is allowed to offset whatever the dad's loss was. The dad didn't get to use that 50, so the son can use that 50 to offset his gain. Therefore, since the dad had a $50 loss that wasn't used, the son can use it to reduce his gain. So in this case, the $150 gain becomes simply $100. So the dad had a $50 loss, none of it was allowed. The son can use that 50 that was disallowed and only record a $100 gain. Okay, very similar. Son sells the stock for $130. So the son he got $130. He gave up $100 to buy the stock. So he has a gain of $30. He can still use that $50 loss from the example. Therefore, it offsets it completely. You don't get to claim a loss, but you can take it down to 0. So the son has a $0 gain and 0 loss, even though he had a realized gain of 30. All right, that wraps us up for week 13, and I will we'll get back. We'll have probably quite a bit shorter lesson or lecture next week with rental activities. Again, it's not real difficult, I don't think, and just go over a couple items that are new, and then we'll be finishing out the semester here very shortly. So turn in your homework. If you get it by Friday morning, I'll look it over for Chapter 12, along with your tax return. The one thing that I should note before we stop here is make sure you look at example or page 12.8 and 12.9 for Form 8824 when you're doing the tax return. Your numbers should be they should be similar to what's in the book. Like, for example, you're going to fill in the dates on Form 8824 for lines 3 through 6, and then you shouldn't have another line filled in until you get to line 15. Don't get confused and put something in line 12 and 13. Read through it real carefully about what line 12 and 13 really are, because a lot of people like to try to put something there when it doesn't belong there. So just give you that little bit of a heads up. Because line 13 says, complete the note right above line 12. 13, 14 says, complete lines 12 through 14 only if you gave up property that was not like-kind. And in the example in the book, there is that situation did not happen. Okay, I'll see you guys next